We continue to maintain a stable outlook for the oil and gas sector in India. For the upstream companies, the stable outlook is largely driven by the expectation that these companies will maintain their net realizations between 45 or 55 per barrel, which is the same level that they've seen over the last 10 years. Additionally, the subsidy burden is likely to decline to 300 billion rupees, assuming an average crude realization of 47 per barrel in FY17. This will result in the subsidy share of upstream companies declining to a mere 12 billion. The downstream companies, that is the OMCs, would continue to report healthy GRMs, driven by the healthy growth in domestic demand, which is likely to keep the utilization levels of the refineries comfortable. Moreover, the high complexity of the refineries and the presence of downstream processing facilities also is likely to aid their GRM profiles. The midstream companies in the sector are likely to benefit from the increased gas transportation volumes, which would lead to a kick-in of the operational leverage post the renegotiation of the contract with RasGas Qatar for imported LNG. In India, the net realization for the state-owned upstream companies is an interplay between subsidy burden per barrel and the Indian crude basket price. Though the price of crude internationally has declined, the subsidy burden per barrel has declined much more sharply. We estimate at a crude of 47 per barrel in FY17, the subsidy per barrel would be a mere $1 per barrel and the net realizations would be closer to $46 per barrel. However, if the crude price were to fall below $45 per barrel, the subsidy burden would decline to zero. However, if the average crude price stays at the current level of $35 per barrel, the upstream companies could announce capex cutbacks, as has been the case globally, with players reporting 50% to 80% capex cutbacks. As at the low crude prices, the quantum of subsidy is also likely to decline to 300 billion rupees. The OMCs are likely to see lower working capital requirements to fund the time lags in receipt of subsidy from the government. This will lead to lowering of their interest cost and consequently the profitability. For domestic gas, the availability is unlikely to increase in FY17, and we expect the volumes to stay in the range of 88 to 92 MMSCMD, as no new gas field is likely to contribute to the increased volumes. Moreover, we expect the domestic gas prices to decline further to $3 per MMBTU for H1 FY17 based on the formula announced by the government. Domestic developers have argued that at these prices, it would be unviable to extract gas and hence any new volumes on domestic front is unlikely. We believe imported LNG volumes could see a significant increase post the contract renegotiation with RasGas Qatar for term LNG, wherein the formula has been renegotiated. Now we have linked the pricing of LNG to a 3-month rolling average of the Brent instead of the 5-year rolling average of the Japanese crude cocktail. This has led to a price decline of term LNG from $13 to $14 per MMBTU to a mere $5 to $6 per MMBTU. LNG at this price makes fuel competitive to a lot of customers who had earlier moved to other competing fuels, namely LPG or fuel oil. However, the change in formula also exposes us to faster transmission and greater volatility in changes of crude price being passed on to the gas prices.